But now, instead of constructing the iron butterfly, we're going to construct what is known as the iron condor. So the iron condor, we'll first look at the iron condor versus the traditional condor. And you say, what's the difference? Well, the difference is, once again, both strategies are looking to profit from a range-bound security, taking advantage of little movement. In the case of a traditional condor, you could also put this on from a directional standpoint, either like an out-of-the-money call condor or an out-of-the-money put condor, to target a move either up or down, and then looking for the stock to sit. But the iron condor itself is typically done using when implied volatility or option prices are high, targeting near the at-the-money strikes to take advantage of that enriched option premium. But also, we'd have to be of the opinion that the stock is probably going to be range bound. If we thought the stock was going to still move around whatever price it was trading at, we probably wouldn't put on the iron condor. But the iron condor is a position you might consider if option prices are elevated and you think the stock is going to be somewhat range bound for the given time period. So the traditional condor always results in a net debit, where the iron condor results in a net credit, okay? And you would put on traditional condor, and we'll look at an example. Because it's a debit strategy, most likely traders would put on a traditional condor when implied volatility is low, because you are net paying a debit for that position, put that position on, and you're targeting a move that's either neutral or directionally bent, whether you're looking at a call condor or a put condor. So let's look at the iron condor compared to the traditional condor. So the iron condor uses 4 legs, uses both call spreads and put spreads, okay? The traditional condor, we're looking at a all call condor, but you could use puts, if, depending on what your opinion is. Uses 4 legs, but it uses either all calls or all puts. Now, the iron condor traditionally is more of a neutral income play. We're looking to target those rich options and take advantage of elevated premiums, but with also a neutral outlook. The condor, the long condor, is typically put on when implied volatilities are low. In other words, option prices are inexpensive, and we have either a neutral or directional bias, okay? So, once again, if stock's trading 150 and I'm slightly bullish, instead of, putting on the 145, 150, 155, 160 call condor, I might do something out of the money, like the 155, 60, 65, 70 call condor, something like that. If I were bullish, I might target it on the put side out of the money. But once again, it can be used, the traditional condor can be used in a directional sense or a neutral sense, targeting the at-the-monies as well. There is no cost with the iron condor, because remember, we are taking in a credit, so we're going to receive premium. And with the traditional condor, we would be net, resulting in a net debit. We would be paying money. So typically, iron condors are done when implied volatility is rather elevated. Traditional condors are typically done when implied volatility or option prices are relatively low. So let's